We'll be kicking off here in just a minute as Zoom continues to let the attendees in.
Hello, everybody, and happy Friday. I don't know about you, but at our household, we have a hard time remembering what day it is. Luckily, I have a 7- and 9-year-old who have a good relationship with Alexa, so they check with her each day to see what day it is. And a fun fact is my first grader likes to ask Alexa if she should be doing her homework. So far, Alexa keeps telling her she has no opinion. So I think that's a good chuckle for us to start our day. I want to welcome each and every one of you on behalf of the partners at Boyum Barenscheer to our webinar today to go over the PPP Loan Forgiveness, who, what, where, when, and why to spend those items. And I am happy to be presenting with you along with the COVID-19 team here at Boyum Barenscheer. I'm going to kick it over to Nick. He's going to do a little housekeeping for us, and then we'll get started.
Thank you, Stacy. And like Stacy said, just happy Friday afternoon. I hope it's as beautiful wherever you are as it is here down in Burnsville in my home office. Very quickly, I just wanted to let you know about a great feature of this Zoom webinar. On the bottom of your screen, it should be on the bottom, there's a Q&A button, and a few people are already using it, which is awesome. That's a great spot to pose your questions, and I'm going to be attempting to answer some of them live throughout the whole webinar. Some of them I'll be marking that we're going to answer them live at the very end, and some I will be answering or dismissing once we hit that section of the webinar. So at the very bottom, if you click on that, you'll see there's already 2 questions out there. If you could do us a quick favor and before you type one, take a really fast scan through the questions that are there. And if you find one that's really similar, just give it a thumbs up. That thumbs up button will push it to the top, and somebody's already used it, thank you. And that will obviously make it much better chance that we will get to your question at the end. We expect the webinar, our presentation piece, to be about an hour, and then we'll be doing questions right at the end. So with that, I'm actually going to hand it right back to Stace to get the webinar started.
Thanks, Nick. Okay, you guys, what do we need to know? We need to know what are the things we are going to touch base on for you today. And the first one is PPP was funded again. For those of you who haven't gotten the funds, that was great news. And then we'll go over the EIDL versus the PPP issues and give you some thoughts on that. And then obviously going over the loan forgiveness in detail, giving you the basics of it, the limitations around it, going through detailed examples while using our form that we've created for you that's on our website, talking about the strategies, how do we make sure we get the best benefit, discussing what documentation you should keep, and then going over some other considerations. And then our favorite as a panel anyway is the Q&A live at the end. So with that, we'll kick off to our PPP was funded again. I don't know about you guys, but the amount of reading and researching and following websites and the stuff on the news with the governor and the president, it's been a little overwhelming, but I was excited to see before we kick this off that Trump did sign this 4th round of funding for us that's related to the coronavirus. So that's hot off the press from this morning. So with that, that's going to help all these small businesses that haven't gotten their funding, we hope, and get them all back up and running again once we get through this crisis. Banks are expecting to start again applying for and sending in your application. So get everything to them if you haven't. And with this new round, the $250 billion for PPP money, they're trying to spread out amongst the smaller banks. So we are hopeful that that'll help each one of our clients get the funding that's needed. And then the EIDL, if you've gone on to SBA.gov and have not applied, you'll see that they had stopped accepting applications because the funds had run out. Keep watching that website. I apologize I didn't look at that before I jumped on this, but hopefully they'll be opening that up. And so be sure to go in and apply for that if you need it. And then that also will be another $10 billion for the grant portion, which is the $10,000 that you hear about. That's been limited to $1,000 per employee. So now we'll go into our EIDL and our PPP. And we, of course, wrote out the full names of those loans, but I don't think anyone's calling them by the full name anymore. So for the EIDL loan, remember these funds are for working capital, so things other than payroll, because if you use them for the same funds, you'll get yourself in trouble if you have both, or you'll have to refinance the payroll portion of the EIDL into your PPP. The EIDL really is, outside of that grant, long-term debt for your business. And the rate for businesses is 3.75% over 30 years. For the nonprofits, it's 2.75%. And again, as I said, that $10,000 grant, if you're using it for payroll, will be refinanced into your PPP loan, and it gets forgivable that way. You cannot use the EIDL and the PPP for the same thing. I cannot stress that enough. It's got to be for different uses and different funding purposes. So be very careful if you do get both of these, to keep them in separate accounts and track them with the different costs. We think that you potentially could use those EIDL funds that you have for payroll after your 8 weeks is up with the PPP. Again, the EIDL loan is not a short-term 8-week deal. This is a longer-term funding mechanism. So again, watch for more updates on that. And there will be no double dipping with the costs that you're using to be able to have it apply to both loans. So again, the accounting and keeping that separate is very, very important. Under the PPP, I think we all know with the payroll protection, we're using this mainly for payroll costs. And if we track and keep all of our documentation and use the funds for the payroll or the other costs, we are working hard to try to help all of our clients make that forgivable. And again, we'll go through all the details of the rules. And this is very short-term debt. If it's not forgiven, it's a 1% over 2 years. And again, I'm going to say over and over, do not use the EIDL and the PPP for the same costs, especially in that 8-week period. And again, no double dipping of the uses of the two. And with this, I get to kick it over to Tiffany, one of my team members on the COVID-19 team.
Great, thank you, Stacy. Hi, everybody. As Stacy said, I'm Tiffany. I just want to welcome you, in addition to Nick and Stacy welcoming you. Thank you for joining us today. Hopefully, we're able to provide you with a lot of information. There will be parts all throughout that we're saying we still don't have firm guidance from the rules and regulations on. I know it's frustrating, but please be patient. The SBA and Treasury are working hard on getting those out. So I'm going to talk a little bit about forgiveness and just the basics. So we're just going to run through this first slide, just kind of gives a broad general idea of an example. We're going to get into more specific examples later, but this is just going to lay out some facts and circumstances around a broad example. So we're going to say you got $250,000 in your PPP and you spent $150,000 total, which included both payroll and non-payroll costs. Of that $150,000 spent, we're going to assume that you were able to rehire or retain 15 employees out of 20 that you had during your base period. So you were running at basically 75%. fully staffed during your 8-week period. We're going to assume no employees made over 100,000 during the year on an annualized basis, or in other words, nobody made $15,385 during the 8 weeks. And you don't have any employee compensation cuts that exceeded 25% from the first quarter of 2020 to now the 8 weeks. So if we assume those facts, you're eligible for forgiveness on what you were able to spend of the loan. So we've spent $150,000. We're going to assume that that breakdown between payroll and non-payroll was in accordance with the 75-25 ratio, which we also will talk about again later. So assuming that 75% of your 150 is eligible for forgiveness because you were able to get your employment level back to 75% of where it was. So you get $112,500 in loan forgiveness. The rest is a loan, and the rest is the $137,500, and that loan will have a 1% interest rate over 2 years. So you have $100,000 of cash left over, and then you owe a total loan of $137,500. So just a real basic example. Now we're going to get into a little bit more about the forgiveness. Those of you that have already been funded, you know this. The lender makes the first disbursement of the loan no later than 10 days from loan approval. And likewise, as a borrower, you have that amount of time to actually sign the loan documents once you get those from the lender. So you'll want to make sure you're looking at those loan documents and getting them signed and back so it can get funded. The 8-week period for tracking your debt forgiveness and what you have spent starts with the first loan disbursement that day. Now, the bank could take up to 30 days before they disperse all the funds, though we have seen in most cases the full loan amount dispersed on that first disbursement. The 8-week period after you get the funds in your bank account, is that loan forgiveness tracking period, or we also call it the covered period. And only costs incurred and payments made during those 8 weeks count towards loan forgiveness. Now, we'll get into answering some questions later about this. The law is pretty specific about costs incurred and payments made, though we've had a lot of conversations amongst our team about what does that mean and how does that look, because there are a lot of things that easily fall into that definition, and then there are things that don't maybe fall into that definition. And so we're hoping that more guidance is going to come out on that. You do need to use 75% of the loan is required to be used for payroll costs. Now, we've dealt with payroll costs when we were applying for the loan. The definition for those payroll costs that we did to calculate the loan amount has not changed. It's the same on the forgiveness end as it was when we were applying. So payroll costs include gross wages, which also includes commissions, bonuses, tips, paid vacation, paid sick, as long as it wasn't under the Families First Act, and any leave. It also includes employer paid retirement benefits, group health care benefits, employer paid portions, and then state and local taxes, which are your state unemployment. Gross wages are also limited to $100,000 annualized per person. So if you have someone who in compensation will have more than $15,385 during that covered period, the 8 weeks, you only get to use $15,385 for the forgiveness. And that does not include their benefits. That's just compensation. So what do we do with the other 20? If we spend 75% on payroll, what's the other 25%? That's what we're going to call non-payroll costs. And what you can use the PPP loan funds for to qualify as non-payroll will be rent. Now, rent is really vague so far. So again, another area that we're hoping to get more clarity on. Right now, rent is defined as rent obligated under a leasing agreement in force before February 15th of 2020. So that could cover a range of things. Right now, we are in agreement that that includes a lease for real property. There's some question as to whether it can include leases for personal property. What do we do about capital lease arrangements? You know, you might have a net lease, so how do those components work into this? We're hoping to get more clarity around that, but right now it's rent obligated under a leasing agreement. Utilities includes electricity, water, gas, phone, internet, and transportation. Probably the vaguest part of that is transportation. Again, hoping we get more clarity. We're not exactly sure what transportation includes, so that's left to some interpretation. Other non-payroll costs, your mortgage interest for any mortgages you had in place before February 15th of 2020, and it's interest only. You cannot use these PPP funds for the principal. And then you can also use PPP loan funds for other interest expense on other debt, maybe a line of credit, maybe you have other commercial loans. You can use the funds on interest expense for that debt as long as it was in place before February 15th of 2020, but you cannot have it a part of the costs that are forgiven. So it's not forgivable, but it is a use of funds. All right, so now as you're working through your 8-week period, there's going to be some limitations that come into play on what can be forgiven. So you're doing, what we're encouraging is plan. The more you can plan on the front end and then monitor throughout your 8-week period, the better off you're going to be at the end for this forgiveness. But there are some limitations to be aware of as you work through. The maximum amount you can have forgiven is what you spend. So in our example that I went over earlier, it was a $250,000 loan. If you only spend $150,000, then automatically $100,000 cannot be forgiven. So forgiveness is only to the extent that you've spent the funds. And as I mentioned before, 75% or more, it can be more, used for those payroll costs that we talked about, and only up to 25% on the non-payroll that we talked about. Anything in excess of the 25% spent on non-payroll will not be forgiven. So those were two of our limitations. The third limitation I'm going to talk about is that if you have reductions in pay of more than 25% for employees that make less than $100,000 annualized, there will be a reduction to the forgiveness. So this is an area as well that hopefully we get a little more clarity. Right now it's written that you look at employee by employee and how much did their pay change from the first quarter of 2020 to the 8-week covered period. There is some speculation that when we have clarity, they're going to look more on a total compensation basis across all employees making less than $100,000 and not on an individual basis, but just stay tuned for any clarity we get on that part. The last limitation is if there's reductions in full-time equivalents during the 8-week period. So you've probably heard, if you've been tuning into us or just reading and other webinars, there's 2 base periods that you would look at to see what your base headcount, full-time equivalent headcount needs to be during the 8 weeks. So once you've calculated that, if you don't get your headcount back to that on average during the 8-week period, your forgiveness is limited or you're penalized in that forgiveness. So for example, if you achieve 90% headcount during that 8 weeks, then at most 90% of the loan can be forgiven. There is an exception. If you're able to bring the headcount, the FTE headcount back up to where it was February 15th, and you can do that by June 30th, then you've restored your forgiveness and you're eligible to have it all forgiven up to the extent that that the loan proceeds were spent. So that's a little bit on those forgiveness components, the limitations, kind of the basics. I'm going to kick it over now. We're going to start getting into some more detailed examples, and Chris is going to take it over.
Thank you, Tiffany. The tax tiger has arrived. He's in his very cold basement right now in Eagan, Minnesota, and I'm wearing wool socks because it's freezing in my own basement. But let's, if you're ready, let's dive into a very detailed set of examples. This first one really covers a lot, and I think it really can start to show and demonstrate how having a strategy is required, and having a strategy can make a massive difference in this forgiveness. So the first thing is we'll set up these first 2 examples that I'm going to go through. They have a similar fact pattern. So it's, once again, we're at the $250,000 of PPP money, and I've chosen April 20th as the date. And so that's, if there's $250,000 funded, that's $100,000 per month average payroll cost, and there's 20 employees. And so then the 8-week period would be up on June 14th. And this first example, we're going to be looking at a salon. So that's a business that's currently closed, obviously, and we're not exactly sure when that business might be able to reopen. But in this example, we're going to say that May 11th, they're allowed to reopen by whatever state rules there are. So if you look at their 8-week period, they're going to have 3 weeks of being closed and 5 weeks of being open for business. And in this example, we'll just use $30,000 of total sort of rent and utilities costs during that 8-week period. So the base level here is you just don't really have a strategy. So what happens when you don't have a strategy? You're going to hire people back. So those 20 people, you'll hire them all back ideally on May 11th, and you'll just use the structure that you had before. And so they're going to have 5 weeks of payroll, but certainly in a salon business, oftentimes it's mostly commission based. And with some of the limitations on the number of customers you might be able to have in there at once, for this example, we'll just say that on average, people are making about 60% of what they're making before because it's so heavily based on commission. So if that's the fact pattern, what are the results of that strategy of doing nothing? You're going to spend about $105,000. You're going to spend the $75,000 on the payroll and $30,000 on the rent. How much ends up being forgiven? Well, that's where it gets a little more complicated. You're going to end up with about $78,000 forgiven because you're going to run into a couple of the limitations that Tiffany was just talking about. First, you're going to have too much spent on the non-payroll costs, because if your total is 105 and you spent 30 on rent, then you've spent in excess of 25%. So you're going to lose some forgiveness there. You're also going to lose some forgiveness because you've reduced the wages for those employees. So if they're only making 60% of what they were making before, you're going to lose on that as well. So you end up with 78,000 forgiven, which means you've got a PPP loan outstanding of 172,000, and you've got 145 of cash left over that you just didn't spend during that 8-week period. You can spend that 145 in the future on payroll, and so that's great. And it's a low interest rate, so that's okay. So you really end up with 78,000 of tax deductions for all the wages and rent that you paid, but it wasn't with your own money. It was sort of with this free money. So there's some value in that as well. So there's about maybe 20,000 of tax savings achieved from using free money to pay for these deductible expenses. So the total benefit to the owner is about 98,000. You had 78,000 forgiven, and you got about 20,000 of tax savings because you can still deduct those costs. So 98,000 of benefit is okay. But one of the issues here is the employees might be kind of upset because you brought them back. You opened the store, you brought them back, and they were not able to make their full salary because of the restrictions placed by the government. That's not really your fault as the owner, but just the set of circumstances leads those employees to potentially be a little upset. There have been some stories out there where people are making more money on unemployment, and that certainly can be the case for lower wage people. And so those people might also be upset. They're like, I was making $1,400 a week or $1,000 a week on unemployment, and you're here paying me $900 a week. I have no incentive to work. I have no reason to do that. So, I mean, I think this is doing nothing is going to lead to sort of a mediocre result, I would say. You get 98,000 of sort of net benefit, I would call it. But you've probably also made most of your employees somewhat upset with you, and that's not ideal. So what does a smart strategy entail? Well, first you could leave the owner, who's one of the 20 employees. They're still working. You're still trying to run this business, trying to figure out how things are going to happen when you're able to reopen. So leave the owner on payroll. So now you're picking up 3 weeks there. The other 19 employees, maybe you could hire them back a week before the salon opens, because you're going to have a lot of new processes in place to deal with these restrictions. You're going to maybe have some other things they can do from home, more education things, learning about marketing. So all those things that maybe you put off, the employee education things, so they could maybe be doing that for a couple of days in addition to the meetings. So there you picked up an extra week of salary for the other 19 people. Another good idea might be a rehire bonus to the 19 employees that you're trying to get back into work. I wouldn't do this for the owner necessarily. Plus, you've been keeping them on payroll, hopefully. So in order to get them back to work, I think a little incentive could be called for, and it could be a good way to spend more of your money and to offset sort of the unemployment issues where they were potentially making more on unemployment doing nothing. So you might need to incentivize them to get them to come back to work. So that's maybe one way to do it. Another strategy would certainly be looking at the commission structure and just putting a minimum commission in place so that nobody is making less this year than they made the year before. Just guarantee them a minimum that's going to equal sort of the amount that went into that PPP loan. If you, oh, I think my cat might be interested in this example. But if you're interested in bringing them back, we'll guarantee them the same amount of pay so that they're not upset with you and they're not dealing with only getting 60% of the pay, because that's not really their fault. It's not really your fault either, but that can be a great way to increase the pay. Something else you can look at would be making sure you're making the retirement plan contributions during the 8-week period, as opposed to waiting to the end of the year or the end of the quarter, which might fall outside of your 8-week period. Maybe you can pay out some accrued vacation time. So in our example, that's another $1,000 an employee. So how does this shake out when you have a strategy? You're going to spend $239,000 of the money, and you're going to have $239,000 forgiven. So if you notice, we've now avoided all of these limitations. Everybody's making the same amount, so that limitation doesn't apply. By putting more into payroll, you don't have an issue with the 25% for the non-payroll costs, and then you're just obviously spending a lot more of the money, and so you're not limited there. So you end up spending 239 of the 250, and all of that 239 is forgiven. And so you're left over with a little bit of PPP loan, and you can use that for future payroll. The owner now, if we're thinking about the owner of the company, they've just gotten 239,000 of tax deductions with free money, which is worth maybe 60,000 in tax savings to them. And I mean, that's recognized at the end of the year when they're filing their business tax return. But I think that's still worth noting. So if we look at just doing these few little changes, now we have 299,000 of net benefit to the owner. And your employees, they probably love you because you guaranteed them their full salary. You gave them a bonus to come back to work and come off of unemployment and work for you. So I think there can be a lot of goodwill built up with the employees with this kind of a strategy. And I mean, I think also the net benefit to the owner of the company is tremendous. So if we just go back and look at the do nothing, we ended up with about 98,000 of net benefit, and you have some cash on hand, which is accruing at a low interest rate. So that's okay. And you'll use that in the future. But the real benefit of this, outside of getting access to some cheap money, you've got about 98,000 of net benefit. You do a few things, and you have 200,000 more in net benefit to the owner of the company. And so this is where some small changes to each of those limitations can really, really add up. And so we have a calculator, which is on our website. And I just want to pop in and show you this quick because I think it's tremendous. The whole team's worked on it, but Tiffany put together much of this. But it's how you can use this to do a number of things. There's an overview here which explains it. This is more on the front end, these two tabs on calculating how much you're going to get. But assuming you already have it, let's jump to the third tab, the loan forgiveness amount. And so this is where, if you can see this, this is where we're looking at, you've got 250,000 of your PPP loan. It's calculating the dates for you. And then down here, we're entering what we're spending it on. So this was, if you remember the do nothing strategy, you end up with 75,000 of payroll and you've got your 30,000 of rent. But then here, you've got these other limitations. So you've got the limitations on the head count, that doesn't apply because you ended up with all the people back, but you have this additional limitation on the wages for all of the individuals. And so that's calculated, there's a separate sheet number 4, and that'll help you sort of annualize their compensation. Well, this person was making 50,000 on average before, now they're at 60%, and so you're gonna have an amount that's not forgivable. And so that adds up by all of the employees right now, and that's where you sort of see these limitations can stack up. We've got the potential amount forgiven, then we have a reduction because you didn't spend it all. Then you have the reduction because you, on a percentage basis, you spent too much on the non-payroll costs. And then if we scroll down, this is where you would have a limitation based on head count. In this example, it doesn't apply. But then you have another limitation based on the reduction in wages, and that's how we get to sort of the ending amount forgiven. So I want to encourage everyone to, it's on our website right now, you can go on and download it and really use this to help project out what your loan forgiveness is going to be, because it's, I mean, this stuff is very complicated. You can't just eyeball it all of the time and figure out how it's going to shake out. So you really want to run through the numbers and see how it's going to play out. So I got a second example here, which is similar. We got the 250,000 again, and this one might be a restaurant business. So they're also closed to the public, but they're still working. They're doing takeout. I had takeout last night, and it was pretty good. So they're still working, but they're maybe at 20% capacity, and they might be looking to reopen June 1st, and they're probably only at 50% capacity because there's a lot of restrictions potentially on how many people can be in the restaurant or whatever. We'll see how that shakes out. But once again, we're saying, what happens if you do nothing? You do nothing, you've got 20% of the employees on payroll now, and then you just jump to 50% on June 1st when you're allowed to reopen. So how does that look? You end up spending 81,000 of the money, and you end up with only 14,000 forgiven. So this is where a couple of those limitations are going to come into play. You have not hired everyone back by June 30th because you're still at 50%. So that's a big limitation. You're also limited by the 25% non-payroll cost because you still had your 30,000 of rent, so that's too much. And so you get very much limited. You get almost no forgiveness. Your PPP loan is going to be 236, but you're only going to have 169 of cash on hand. The tax deductions are nominal, so your real benefit here is 17,000 to the owner. What would a smart strategy include for a restaurant? I think in some respects they can be similar to some of the ideas of the salon in example 1, but a couple other things to really focus on for a restaurant. And we got these from Nick, who's our restaurant guy, restaurant and brewery guy, but really focusing on the FTE count. I think that's critically important. And even if June 1st, you are not fully staffed up, that's okay. You might still be at 50%, but you got to find a way to get staffed up by June 30th. Because the math on that is really tremendous. You can get a lot more forgiveness if you can get fully staffed up by June 30th. So what are you doing? Maybe you're hiring delivery people that you never employed before, trying to do self-delivery. Maybe you're keeping an eye on the FTE rules, which say if you work 30 hours per week, that counts as one FTE. So maybe not everybody needs to be 40 hours a week. You can get them down to 30 hours and still count towards that FTE and get towards your count. Maybe you hire some people back and you're just cooking and delivering to neighborhood businesses or essential workers, which maybe isn't generating any revenue, but it can still be productive, especially once you're able to be open in that June timeframe. So really trying to ramp up by June 30th. I think there's certainly some other ways to be creative. Maybe you need your website redone. You could hire someone to work on your website in June just to get that FTE count. So just doing a couple of those little things, smart strategy results, you're going to spend 81,000, but you're going to have 71,000 forgiven just because you've jumped up by hiring people in late June, which is after your PPP period, so that you get more of that forgiveness. So I think a tremendous jump in the tax benefit to the owner, and that's just by focusing on that June 30th date and seeing that you can get as many people, as many FTEs restored as possible before that June 30th date. So a couple of things to keep in mind those are a couple examples for businesses that have really been impacted in a negative way. So let's throw it to Randy to go through this third example of a business that is still open and they can be a little more aggressive with their strategy.
Thank you, Chris. Yes, in this example, we are going to look at a construction company or manufacturing business. Same example, really same fact pattern as far as the loan amount. We've got $250K funded on April 20th. Their base headcount for people, FTEs, was 20. They're now currently at the date of the loan, they're at 16. So they're about 80% of where they were. And it's a critical business. So they've been in operations, they've seen some softness, and we've seen a lot of businesses like this that are, a lot of our clients are, in these type of businesses, in the trades, construction, manufacturing, et cetera, where they haven't currently seen the softness and are still operational. So they can take a little bit more offensive sometimes and certainly less defensive approach as they go at this, depending on the business. So some of the things we want them to do is to look at backlog, pipeline, to get some of the tools in place to really model this out, including what Chris had mentioned, our forgiveness calculator. But we'll talk a little bit later about a 13-week cash flow and really just laying out a plan for the next quarter with a focus on those 8 weeks. So the do nothing strategy, what does that do? And they're in a much better situation because 80% of their staff is there. So they've got revenue, they're doing okay. So they've got 178,000, and we basically just prorated this. 178,000 of money spent during the 8-week period, 148K on payroll in this example, 30K on rent and utilities. So they're at 83%, no issue on some of the limitations that Chris and Tiffany mentioned earlier. They've got 142K forgiven. That's 80% of the amount expended, which that math is exactly the illustration that Tiffany went through. Basically 16 divided by 20 gets us to 80%. So they, not bad, 57% of the loan is forgiven. They've got 108K to be repaid on a loan, and they've got 72 in cash. And basically the cash difference in the loan difference are equivalent to the money spent versus the forgiven amount in the first 2 points on this slide. But they've got low interest for 2 years, so pretty decent. So some of the smart strategies I think that we could look at in this case, I think as Chris mentioned, on a bunch of those strategies apply to a number of industries. In this particular case, we're looking at, management coordinates the loan bring back, or the loan would bring back 2 key employees. They're really revenue focused, a project manager and a sales engineer. And they're sitting pretty good right now. They expect their current projects to get them by the next few months, but their visibility and uncertainty with the market, they need stuff for later, second, third quarter. They're concerned about later on. And by bringing these 2 people back, they're not only, it's not just expense, it's creating opportunities that should bode well beyond the 8-week period. They also increased their FTEs to 18, which, as we do the math, is going to be 90% on a level. So that's terrific in the equations that we do with this. They consider other things, management reviews, other FTEs, and they basically decide that they're non-revenue generating, and they decide to wait until late May to assess the market. There's a few things in the interim that they look at doing to help with, I think, retention, customer relationships, not customer relationships, more of the team relationships, and that is funding profit sharing, basically 8 weeks. We're not trying to get too greedy, but pre-funding 8 weeks of profit sharing during that 8-week period, we think is a good use of funds. That would probably include 401ks that we're matching, but in particular, the one-time or quarterly payments that are often made, make sure you get 8 weeks into that period. Facility lease, our interpretation, Tiffany touched on it some. We think the net lease provisions which include real estate taxes and operating expenses under a lease agreement that's documented on a pre-February 15, 2020. We think those are good. So they make sure to pay their 8 weeks of net lease expenses during that time. One of the things we want to continue to do is they continue to assess their team, because they recognize they're at 90%, and they also recognize that they have to spend it to get it on the debt forgiveness, but they want to be smart about it. And so they're continuing to evaluate their team, and they don't have additional work. And so they feel like they can't bring back their team to 100%. And so they hold off on that. Their margins are very high. And certainly if they could have brought them back in this example, I think the math would work tremendously for them, but they choose to keep a little cash and liquidity and get by the next few months. So what does this do? This changes the math quite a bit. They've spent $225,000 of the $250. 90% of that's basically 202Ks forgiven, and 81% of the loan, that's 81% of the total loan. Basically, between the first example, they spent $47,000, and including profit sharing and rent that they would have already paid anyways, and they get $60,000 of debt forgiveness. It's just one of the examples where, when leveraged properly, there's a multiple on the spend during that 8-week period. So we've got leftover PPP loan of $25K to be spent on future payroll, 1%. We really, if we did a Scooby-Doo alternative universe, if they would have had the additional $23,000 forgiven without spending anything if they brought employees back by June 30. But in this example, we determined they weren't going to produce any revenue, and we would have a hard time getting them back. So we decided to play that differently. Certainly there's going to be a lot of cases where you bring back the team and get 100% forgiveness on the full 225. So look at that closely and run multiple scenarios on this. The thing that I think is important is we want that 8 weeks not to just be get loan money and spend it and have nothing left. We really want production, revenue, and in this example, those 2 sales leaders, bringing them back creates opportunities and future revenue for the company, which I think is terrific. So some strategies. We talked about a number of these, I think, along the way, but we want to reinforce some of them and bring up some new ones. So certainly be conscious of the timing of those other covered expenses, rent, utility, mortgage, interest. Take advantage of the 25% and really model out the timing so you take advantage of those. One way to back into this, and this is certainly an act focused on payroll. So take your projected payroll cost, divide it by 0.75. That gives you your total spend and allows you to see how much you can spend on these other expenses that we have listed on that point. The next 2 points, I think, are, we know you have to spend it to get the debt forgiveness. These next 2 points we've touched on for sure, but I think it's worth re-emphasizing that there's two main characteristics that allow for the percentage forgiveness. So you spend it, how much of that can I be forgiven? And one is this June 30th provision, which Tiffany got into the details of that, and Chris touched on our calculator. But if you bring people back by June 30th, that's a tremendous provision. If you're not at 100% restoration, and if you are looking at less than 100% forgiveness, every business should mark on their calendar, probably starting mid-May, to assess can they get their team back to June 30. The more layoffs you have, the more that assessment is critical. And so we for sure want to spend some time on that. In the computations of the FTEs, you can use the lower period. So really focus on, is it lower the first 2 months of 2020, or was it in that period in 2019? And we're comparing that to that 8-week period. And we're trying to use the lower math and trying to get base period to 100% or more. If we can, we're at 100% forgiveness. Run multiple illustrations. I think our calculator is a great way to do this. If you can get money, the money spent often has a multiple on forgiveness. And if you can combine that with actually production, revenue generation, better systems process, I think it can be amazing. So really map that out, run scenarios. We went through examples, but literally there's 5 to 10 examples for each company out there. The 13-week cash flow template we've talked about in other presentations we've done. It's a great tool. It's on our website. And the main thing we want you to do, the forgiveness tools are tremendous, but the 13-week cash flow is also going to help you forecast revenue and your other expenses. And we want to make sure that we're all a little bit in the business of debt forgiveness for this 8 weeks, but you're also in your core business, and that's to serve customers and to do things well. So we don't want to get so obsessed with forgiveness that we forget about some of that stuff. And just lastly on this is that sometimes liquidity and saving a little bit of the loan can work if you're not going to get production. So map that out and figure out what's best for your business. The next slide, we have the tax tiger back to talk about some additional forgiveness strategies.
Thanks, Randy. And sorry to anyone if Randy was a little glitchy there. Maybe the internet in his side of Egan is not quite as fast as my basement internet here, but sorry about that. But I hope you got everything that he was um, providing. So here are just a few more strategies. We're looking at certainly keeping the owners or like the key management people on payroll when they're closed. Hopefully you're still working, you're still trying to figure out what the business is going to do if and when you reopen. We think that a rehire bonus for employees who you previously laid off or furloughed really seems like it could be a good idea, and it might even be required to get them off of unemployment. So, I mean, you can offer them their job back, but if they're making more on unemployment, they might not be real excited to come back and work for you. They might have an issue on whether or not they can continue to claim unemployment, but they don't necessarily realize that. And I think potentially even a retention bonus for, so if you laid off like half of your staff and then you're going to bring back the other half and you're going to give them a rehire bonus, well, maybe a small retention bonus makes sense for those employees that you kept on and they've been working at home, maybe through difficult conditions. They're juggling family, homeschooling their kids and trying to get work done at the same time. And so I think a retention bonus could make sense as well as that rehire bonus. For anyone with variable salaries, I do think looking at having a minimum compensation model so that they are not making less than they made the year before. So if they're sales based or service based, like in the salon industry, but I really think if your PPP was based on them making 100,000 a year, and now they're back to work or they're continuing to work, but their income is down because of the economy and because of limitations placed on them, I think a minimum compensation model might really work both for you as the employer trying to get that loan forgiveness and not be limited, but also work for the employees so that they're not really frustrated with the situation. The PPP is to protect their paychecks. And so I think that's certainly within the spirit and the whole idea of this. I think we'll get a little more guidance on this hopefully, but it says the costs need to be paid and incurred. So you might need to be running an extra payroll before the 8 weeks is up. So for example, if your 8 weeks is up on a Thursday and you normally pay people on Friday, maybe you do an interim payroll on that Thursday to get that final payment in within your 8-week period. Hopefully we might get a little more guidance on that, but as it's written now, it appears it really needs to be on a cash basis paid within those 8 weeks. So maybe running an extra payroll at the end is a way to just get caught up for that interim period or that half a week or whatever. Paying overtime. So we have a few clients that are able to work and they are busy. Maybe they can pay overtime to people to get more of the wages into that 8-week period. If they're able to produce and they're able to do good work, overtime is certainly acceptable and allowable. So consider that if projects are currently busy, but maybe you won't have work for them in the future, or there's some time critical project people are working on. As Randy mentioned, really looking at those retirement contributions and making sure you're getting your 8 weeks of retirement contributions paid inside of that 8 weeks. A lot of people will do it once a quarter. If your 8 weeks is up June 15th and you would normally make your retirement plan contribution June 30th, that's not going to help. So let's accelerate that and let's say, all right, we're going to make 8 weeks worth of this payment and we are going to do that during the 8-week period so that we're sure we're getting to count that towards our payroll costs for all of these calculations. Especially like for the restaurants, looking at the FTE count and just understanding that 30 hours per week qualifies as full-time. So if you're bringing people back, you do not have to bring them back at 40 hours a week. You can bring them back at 30 hours a week, and that will still count as one FTE for all of these limitations. And then just a few things that we would not recommend you do. So, I mean, I think these can be common sense, and there's nothing specifically saying you can't do these things, but we think these are definitely no-nos in terms of dramatically increasing wages to owners, family members of owners, those types of related parties. Switching someone from a 1099 contractor, which doesn't count towards payroll cost, putting them on payroll, and then just switching them back after the 8 weeks is over, that seems like a big problem with the IRS just waiting to happen. So we would not recommend doing that. You should look at your contractors and see, you should be evaluating that every year to see if people should be a 1099 or a W-2. But you just don't want to be doing things during this 8-week period and then completely undoing them the day after your 8 weeks is up, because that seems pretty shady, and that seems well outside of the intent of the PPP program. And certainly excessive draws, the owner draws or distributions are not considered specifically because they're not payroll. But I would refrain from doing excessive owner draws. That just doesn't look good. Making the big non-essential purchases, like you go out and buy a Range Rover in the middle of your 8 weeks with money that you have, and you only have that money because you got the PPP money over here paying those things. I would be careful about. You really want to focus on the essential operations of the business, focus on making smart decisions with payroll, but not doing sort of the crazy things, the big purchases during that 8-week period. So documentation is certainly a big part of this, and we've talked about this before if you've been tuning in. Separate bank account, we think it's critical. It is not required technically, but in terms of doing your accounting and your record keeping, seems like the best possible idea. Then what you would do is reimburse yourself, reimburse your main operating account when you have qualified expenses for the forgiveness. And so you do that to certainly monitor the 75-25 payroll rules. And then you don't have to go changing around everything with your payroll. We have a tab in our big spreadsheet that'll help you calculate how much of the payroll costs is allowed. So it's not just that your payroll happened on Friday and an amount was withdrawn from your account. There's a bunch of modifications to that to figure out what is the reimbursable or sort of the allowable forgiveness number. And so you want to figure that out and then just transfer the money from your PPP account back to your operating account so that you're doing the proper amount on each payroll run. So you're not paying people too much, and you don't adjust for all the withholdings and all the rest of the stuff. Certainly keeping documentation and receipts for like the mortgage interest payments, the rent payments, the utility payments. You're going to want to keep those in sort of a separate file for this 8-week period. On those, it's the same documentation that's required that you hold just if you were to be audited by the IRS or something. But we want to segregate that 8-week period so that we have a nice tidy file, because at the end of this, you're going to submit this file to the bank, and that's how you get your forgiveness. So you just want to be monitoring your progress, spending your PPP money as you go, and updating the models each week. So here are a couple other considerations, and we'll let Stacy finish it off today.
All right, thank you, Chris. And to wrap up in our last couple minutes, we just wanted to give you a few helpful points that are going to be needed as you wrap up the 8 weeks in this program. You will have to submit a request for the forgiveness to your bank. This is not just a for sure thing, and you'll be giving them everything that Chris had talked about with you. For the amounts that are not forgiven, just a reminder, that amount becomes a loan, or you can pay it back. If you decide to have it be a loan, it is a 1% loan amortized over 2 years, but there's a 6-month deferment of payments. Just remember, interest is accruing the whole time. And again, no prepayment penalty on the PPP loan or the EIDL. And then I won't read through the certifications because you all already went through and initialed them on your applications, but we just wanted them here as a reminder. We are taking on these PPP and EIDL loans because our business has been negatively impacted by the COVID-19. So just keep that in mind. Let's do these in the spirit that they're meant to be and not just take money because we see that it can be free money. And lastly, we all saw with the information the president put out that taking on these loans when you shouldn't have been is not okay, but they are giving these companies that shouldn't have taken them up until May 7th to repay those PPP loan funds. And as we've seen, as the Shake Shack and Ruth's Chris Steakhouse have both done that this week. So with that, we'll jump over to our favorite time, and that's the Q&A session with Nick.
Thank you, Stacy. Looks like a lot of people have already been using the Q&A section, so thank you very much. And since Stacy's video is already, oh, and she turned her video off, sorry. Stacy, if I could have you just flip it right back on. I'm just gonna jump right in. Please fill in some questions as we are going through these, and we'll do our best to get to everything we can. Oh, nice easy one for you. Is this PowerPoint available, and is this webinar available later?
Thank you. Great lead in to our Q&A section. We have been videoing since we started this, and we will be putting both the recording and all of the slides up on our website within 24 hours.
Great one. So two that are sort of tied together. There's been a lot of rumors or misinformation around having to spend money within 10 days of receiving the loan. Can you address that? And what are the rules on the timing for the whole 8 weeks of forgiveness?
Yes, I can. So the 10 days that you've heard in the news, that's the 10 days that the banks have to fund your loan. So after they've approved the loan, they have 10 days to get that to you. I don't think any bank is taking near that amount of time, but that was the confusing part. Don't worry, for you, you don't start counting your 8 weeks until that loan has been funded into your bank account. So it's on a calendar basis over 8 weeks. So that funding date is day one, and then you'll go out 8 weeks, which you'll see in our calculator. We have that calculating out for you. And that is the time your expenses need to be paid and incurred. So we really think this is on a cash basis. And that's why Chris said, if you've got that last couple days at the end of your 8 weeks and a payroll would be due right after it, make sure you contact your payroll company and run that payroll on that same date.
Awesome. Chris, if I could have you jump back in. Just a couple quick ones for you. And, oops, sorry. These Q&As move around a lot when people post new ones. Can we hire new employees, or does it have to be the same ones we had before?
Absolutely. They count the FTEs, but they don't go like name by name. So you could have, in theory, 20 different new employees. They don't have to be the same people. And certainly if you end up with like 23 employees instead of 20, that's super. All of those payroll costs for the new people will also count.
Awesome. Sorry, video's being a little slow. I think you sort of briefly touched on this, but it's happening to so many people. We're running into an issue of unemployment being kind of lucrative right now, especially if you're in Minnesota. We have very generous unemployment. When you add on that $600 from the Fed, does an employee have to come back, or like how does it work? What if they don't want to?
Well, certainly every employee can choose whether or not they want to work for you. And if you offer them a job, I don't think they're really eligible for the unemployment anymore, but they may not understand that. But once you offer them a job, they are not compelled to take it. And that's why I think those rehire bonuses might be even necessary in some situations to get people to accept your job. I mean, people can work wherever they want. If there's another employer in your industry that is offering potentially a bonus to hire these people, you might just need to, for competitive reasons, just to get people back in the door.
Which is a great lead into, saw several questions, just confirming bonuses are okay, they count, they're part of forgiveness?
They do count and they're okay. I would be reasonable with them. And then the other thing I would point out is that the maximum that any one person can be paid during the 8 weeks is the $15,385.
And that's
So
100,000
yeah, that's
annualized?
just 100,000. That's what 8 weeks would be of 100,000. So if
Right.
you regularly give bonuses in May of $10,000, you can do that. But then you're going to probably end up in a situation where people got paid too much during the 8 weeks, and it's not all going to count towards that forgiveness.
Awesome. That was great. Thank you. I'm going to see if Randy can get his video back on and jump on to answer a couple questions. There you are. So a couple questions just kind of on the back end of the loan is what kind of documentation is required to show economic uncertainty?
That's a great question. I think what we're recommending for people to do, can you hear me? Am I okay now?
Yeah, you look and sound awesome like normal.
Awesome. Thank you. So drafting an impact statement is what we're recommending for people, especially when they have concerns, economic uncertainty, but it hasn't hit their business as strongly as some. So drafting that now, whether that's pipeline being dried up or canceled projects or customers that in their industry that are struggling or competitors, really writing a story now to their file. I've only seen one bank request it. We'll see what happened now that there's been an update with the passing of the bill here. But that impact statement for your file on all the risk factors that you're seeing right now, anything that you can attach to that, I think is really good proof and not as much proof, but comfort in that you have that documented. And because 6 months from now, 8 months from now, hopefully things will look a lot different. And I think putting that away today is good. So.
Absolutely. So a couple questions to keep you on is,
Sure.
Does the expense have to clear the bank, or is it the check has to be written, or do you know how that piece works?
Yeah, our feeling is, as I think as a few people have mentioned, that it's cash basis, and that doesn't mean that it has to clear the bank, but that you would have had to, written the check, and that should be great
Perfect. Just
documentation.
have the check out of your possession. Just don't have it sitting in your
Yes.
desk drawer. But couldn't you prepay rent?
Our belief is no. I think they've been pretty clear about that, and especially now that they've beefed up a little bit of this incurred and paid language. So we think no, and really what you want to do is get 8 weeks of rent in that period. Make sure you do that, and we want the net leases too. So sometimes the net lease expense is a big chunk of that as well.
Which brought up another great question further down is, what if you have property taxes in your rental agreement? That's coming up here in May. If they're not deferred, does that count?
Yeah. So if you're paying 6 months of taxes, our view is that we would, because we're recommending a separate bank account, out of your main operating account, for sure pay, the taxes due May 15th. If you're the owner of the building in another entity, but then, so write the check out of the business, out of your main operating account, but then reimburse out of your PPP account just 8 weeks of full year property taxes that are part of a net lease arrangement.
Great. So a little bit more math and Excel stuff to do, but try to just get that 8-week spirit of it. Love it.
Yes.
So Tiffany, if I could have you come back, it's been a while since I've seen you and want to make sure, hey, well, you were ready. Good.
Here. Hi, Nick.
I love it. Hi. So one of our attendees, they had a reduction in force in February 2020. So it was even before coronavirus hit. Do they have to rehire those people? And will that help or hurt them in their FTE calculation for forgiveness?
Right, so Chris touched on this a little bit, that nothing's requiring you to bring back exactly those same employees, but we want to get our head counts back up if it's at all possible. As I'm working through this with clients as well, they may have had reductions completely, as in this case, before COVID-19, before we were even aware that all of this was happening or going to happen or have an impact on us. And to some extent, we're not 100% sure how the banks are going to look at and deal with everything, but I am encouraging those clients to document what that situation was so that you can have that conversation also with the bank as you put together that package for your loan forgiveness, so they can then convey the information on, if needed, to SBA about that forgiveness. We're unsure if technically if it's going to impact the calculations per se, but definitely, you know, if you don't feel that it was COVID related, I would do everything you can to document that, so you can head to the bank with that information. I think one thing too is, because there's so much information out there and there's so many spins getting put on this information, we can easily get wrapped up in all those little things of what can I do and what can I not do. And my hope personally is that everyone's keeping the spirit of the law in mind, everybody from the borrower, the lender, the SBA, the federal government, so that at the end of the day, the ultimate goal is met, that we can keep business open and keep people paid. So I'm hopeful, because, you know, we can get into the nitty gritty and the tic-tac little finite details, but my hope is that, you know, in the bigger picture of things, that we're all looking at it through a similar lens to be beneficial to the economy.
That's a great plug. Thank you for hitting that. Chris, if I could have you hop back on. Got a couple FTE questions and a little bit of interest question, but very quickly, can you just define the FTE for us and do a super simple calculation of what if I have 3 part-timers? How does that factor in?
Sure. So the FTE calculation has 2 parts to it. The first part is anyone who works more than 30 hours a week counts as 1. So you figure out how many people are working 30 plus hours a week, and that is going to be your full-time portion. And so that's your full-time portion, and then you add to it the part-timers. And so the part-timers means anyone who works less than 30 hours a week. You add up all of those hours, and then you divide by 30. So if you had 3 people working 20 hours a week, you would add up all of their hours, you get 60, you divide by 30, and that's 2. So you might have 2 people who work 30 hours, 2 people who work 40 hours. They are going to count as 4 FTEs, and then 3 people that work 20 hours, they are going to count as 2 FTEs for the part-time calculation. So you do the full-time calculation, and then you add to it the part-time calculation based on how many hours they're working in a week.
Awesome. So an owner who's working 80 hours a week does not count as 2 people.
No, or even 3. They count as 1.
But an owner does
Only
count,
1.
right?
Yeah, sure.
Yeah, awesome. And great, kind of a specific question, but can an owner, and this is covering guaranteed payments, which is kind of specific to partnerships, but can owners go from guaranteed payments to draws, or can they go to a salary permanently or over the 8-week period, or what's your recommendation?
The guaranteed payments are essentially salary for partnerships. So there is no switching to a W-2 for people in partnerships. That's not allowed. But the guaranteed payments count. So you don't need to switch. The guaranteed payments to the partners will count, and the draws will not. So just look at the guaranteed payments during that 8 weeks.
Perfect. And very specific question that I'm amazed we haven't actually talked about, but state unemployment is technically payable at the end of a quarter. If you use a service, they do collect it with each payroll, but not all of them do. How does that factor in? Because that is part of the forgiveness, right?
Yeah, that's part of the forgiveness. Like some of these other costs, I would say the same principle applies, that you should capture 8 weeks worth and reimburse yourself out of the PPP funds for what is 8 weeks worth of that, the state unemployment, or at least that's how Minnesota unemployment works. So just be looking at the 8 weeks, and your costs are supposed to be paid and incurred during this 8-week period. So if you got your money and immediately paid like last month's state unemployment, you would not want to reimburse yourself for that. You'd only want to reimburse the portion that was for wages during this 8-week covered period.
Great. Thank you very much. I think I will have Tiffany come on quick. I know we definitely have a lot of nonprofit people that have been attending these webinars, so I'd love to try to help them out a little bit. And this specific one has a lot of their payroll is reimbursed or covered by grants. Should they give up the reimbursement to help them get their salary, the money they're spending out, higher? Or how would that work with the forgiveness?
Right, that's a great question. So you're on the right track in terms of asking and recognizing that if you have payroll costs that are covered by a grant, a grant funding source, you cannot also use PPP funds to cover those payroll costs. So in an example, if you have your employees covered 50% covered by a grant, the other 50% covered from your general operations, then the PPP will come in and cover half, but it can't cover 100%. Now, it sounds like the question is asking, should I try to negotiate maybe a different reimbursement with the grantor? And that would be something I would say that you would have to consider from your individual organization's perspective. Depends on your relationship that you have with that grantor. Over time, if they seem that they might be open to some of those conversations, it might be worth a try depending on if they're a state grantor or federal agency. I have not heard of any agencies entering or entertaining those kind of conversations, but you could ask. The important thing to remember, if you are a nonprofit and you get funds from other agencies or grant sources that are government, you cannot double dip, so to speak. So you cannot use those funds to pay and cover the same payroll costs that you would use PPP funds for. So no double dipping. We've heard that before with some of those other unemployment related benefits too.
Awesome.
Thanks.
Thank you. And Stacy, if I could have you jump back on. Sorry. Can you very quickly jump on the PPP versus the EIDL? How do they play together? Can you get one or the other, both, neither?
I can't jump right now, Nick. I
Yeah.
hurt myself skiing, so I'm in a wheelchair. So there'll be no jumping, but I'd love to answer the question on EIDL and PPP. For those of you that have applied and haven't heard, be patient. I know that's with everything that's going on. We wonder, are we going to hear what's going to happen? We check in with them about once a week and wait on hold to talk to them. They said they are so inundated. They are trying to get the advances out quickly, but they know that the actual loan application itself for the larger loan is taking a long time. If you do get that advance up front before your PPP loans, let's say you got $10,000 in the advance, it just hit your bank account and you logged in one day and saw that extra money, and then now are getting the PPP, that amount is required to be refinanced into the PPP. So it's still the grant portion of the EIDL. They're just assuming that it's going to be used for payroll. So I hope that's the answer, Nick. Is there anything more in depth that I should go into on those?
No, I think that's great. Just
Okay.
Being careful on the two of them. And why don't you help out? We have a single member LLC. What do we know about their forgiveness? We keep talking about payroll. They don't have it, and assuming they don't have any W-2s or any employees in their Schedule C. What are they doing?
Okay, that's a good clarification. So with no employees and it's just you on your Schedule C as self-employed, you'll be using your 2019 Schedule C for the application, which you'll take your net income. So that's a big deal. You have to have net income. If you had a loss, you're not eligible. But of that net income, you're able to divide it by 12 and multiply it by that 2.5 times factor, which we all know is more than 8 weeks. So on the forgiveness side of it, at this point, we hope to get more guidance, but you're getting only 850 seconds of the forgiveness piece. If you do have costs related to that LLC, contracts in the business name for any rent or utilities, then you could also include those. But a lot of people just have home offices and they don't have things in their business name. So it really is limited at this point, but we'll wait and see. There's a lot of time for guidance to still come.
Great. Help me out with the business expansion question. we briefly mentioned, these funds aren't to be used to launch into a whole new endeavor. That's kind of a murky area. And
Mhm.
one specific question was from a restaurateur that, on our side, we brought up delivery or even using your food you already have in a new way. Is that not considered expansion, or do you think that's getting fuzzy at all?
That part is not fuzzy. So restaurants, you guys were obviously closed down or limited. No one can come into your restaurants, and you did just what was needed, right? You made those strategic decisions to find different ways and better ways, or changing the ways you've done business. So that is definitely not an expansion. That's just smart business. So I congratulate all of you in that industry for finding ways to get your food and those great meals you make out to those of us at home that are sick of cooking. So I would not say that's an issue. The expansion piece really is those businesses who grab these PPP loans quickly when they saw, oh, this is money that's going to be forgiven, I want to have it. Business maybe is not been affected much. They now are really needing to look at those certifications. And I definitely would not use your operating funds even to expand the business during this 8-week period, because I do believe that the audits on the backside of this are going to come. It's just going to take some time. They actually, in the bill itself, have a lot of funds appropriated for audits. So again, just make sure we're using these funds in the spirit that they're meant to be used.
Great. Thank you, Stacy. Chris, it
You're
looks like you
welcome.
got a couple that you wanted to jump on. So if you could hop back. Um, if we pay employees monthly, how does that work with the 8-week period for forgiveness? Is it the payments that actually happen during the 8 weeks? Is it just based on how many months it is? What's that?
This is where you're gonna probably want to run an extra payroll. You might normally do it monthly, but I think you could have a pretty bad result if you ended up like with your 8 weeks. Your 8 weeks was up June 20th, but you don't run payroll till the last day of the month. I think you're going to want to change it and run an extra payroll on June 20th to make sure that that is paid during your 8 weeks for sure. I mean, I think some of this timing is maybe yet to be determined, or they could come out with some clarity 5-6 weeks from now. But for now, I would plan on, you can do monthly for April and May, but then in June, you're probably going to want to run an extra payroll, which is going to be a hassle for sure. And then people get 2 smaller checks in June, but I think it can make a big difference on the forgiveness, and it would be totally worthwhile.
Awesome. And that kind of leads into, there's a lot of questions around just the timing of payroll and how all the payroll works. So sort of a 2-part question is, if I got my funds, let's go with your day of April 20th, and we had a payroll come out from our provider on the 21st. Obviously, none of that pay period was in the time we had the funds.
Mm-hmm.
Does it still count? And how does that work with it being a third-party payroll provider? Obviously, if we use ADP, Paychex, or whoever,
Sure.
how does that work since the money's just transferring to them?
Yeah, I mean, at this point, we think that, like, yeah, you get your PPP money the very next day, or even later that same day. You have a payroll run. It doesn't appear that that's going to qualify, because all of that was paying for, it was incurred prior to your 8-week period. So you have the same problem on the back end as you have on the front end, where the first payroll you run after you get your PPP funds, I think you should be sort of prorating that based on how much was incurred during the 8-week period. And then sort of on the back end, you in order to get that both paid and incurred, you might need to run that extra payroll so that you have your sort of partial period on the back end, so that in total you end up with your full 8 weeks. I think it's going to require a little more effort on that first payroll run and then the last payroll run. In terms of when it comes out of your account and when it gets to the employees, I mean, I would say better safe than sorry. If the money goes from you to Paychex on Wednesday and then your employees get it on Thursday, why don't you just run the payroll the day before your 8 weeks is up to be sure that your employees get it during the 8 weeks. It's only a day difference, so I would say better safe than sorry, but I'd also say that's the kind of very small nuance that we might get some further guidance on 3, 4, 5, 6 weeks from now.
Great. Another specific question is, what if we did get the funds originally and have decided to pay them back by that May 7th date that we had heard? Do we owe interest?
I don't believe you owe any interest, but I would also potentially caution you, if you're going to return 100% of the money, definitely do it by May 7th. If you've decided, you know, I made this certification and I'm not feeling so good about it anymore, or you're a public company like Shake Shack and you sort of get shamed into giving it back. If you're going to give back 100% of it, do it by May 7th. If you are doing your cash flow analysis and you got your 250 and you're looking at it saying, well, I think we're going to spend 220, you can give back that other 30 whenever you want. The May 7th date is specifically for the companies who are giving 100% of it back. If you're going to spend 220 and you've got an extra 30 left over, I don't know that I would give it back right away. That's nice liquidity to have at 1% interest, and a lot can change in 8 weeks. I mean, we know what the economy is like today, but what is it going to be like 6 weeks from now? Maybe everything's going to be open and you're going to have more opportunities to hire more people and incur more of those costs. So if you're looking at, hey, I'm going to spend 80, 90% of this, I would probably hang on to that other 10 or 20% and make that decision down the road. Certainly when your 8 weeks is up, you can pay them back everything on that loan. There will be interest for that 8 weeks, but at 1%, 8 weeks that's not going to amount to very much.
Great point. And like you were saying, this is a whole different world. The act passed 4 weeks ago, basically today, I believe. And I don't even think Congress knew what it was going to look like today when they wrote this. I think they thought June 30, we were all going to be back and perfectly normal. And I don't think it's looking like that for anybody. While Randy gets his video back on, I just wanted to take a look at some of the other payroll questions that are in here. Very quickly to discuss what portion of payroll is actually forgivable. It's a tiny bit complex. Some of the payroll providers do have really nice reports that you can run that will help you calculate that forgiveness, but it's gross payroll plus what part of taxes? Because it's not the full amount they pull, right?
Plus state unemployment tax, plus group health insurance.
Dental?
Plus dental, yes. We certainly think so. And then plus employer retirement.
Okay.
That all goes into the definition. The comp has got to be less than the 15,385. That weird math, 100K, 8 weeks of 100K is 15,385.
Great.
So.
Now, for people with employees over 100 that were making over 100,000 in the calculation period, and probably still are, is that going to be forgiven? Is that going to hurt our forgiveness, help our forgiveness? How does that factor in?
Yeah, so some of our tools, basically you're only going to be able to include 15,385 during that 8 week period. So if someone made more than that, you're just not going to that's not forgivable. So if you have, depending on where you're at, you'd prefer not to, you don't want to use your dollars for that, and you can't really. So you want to use it on other people, if that makes sense. So up to 15,385 during that period, make the calculations early so you know where you're going to stand over that 8 week period. And it could be you add people or bonuses or other things. So don't save it for the 8th week.
All right. Thank you. I'm going to have Stacy jump back in. And Stace, we got some seasonal employers and a few others out there, but how does the FTE count work for seasonal employers? What if they weren't even open January 1st or that during that earlier measurement period for 2020?
Yeah, that's a great question, and thanks for asking that, because I'm sure we have more than one on the call with us. So with the denominator, you saw you could pick 2 dates, and obviously the 2020 dates won't work for you. So it is written in the actual bill itself that you will use that February 15th of 2019 to June 30th of 2019 to calculate your FTEs.
Great. I know there's a lot that goes into seasonals and how those calculations are done. So please reach out. Obviously, you can see all 7 of us are up here. One person that you haven't, or 2 people you haven't seen today, Barb Sadi and Larry Davidson, are very, very integral parts of the team. They just got to listen in today and just weigh in as they're helping answer some of these questions, which is very nice. Question on hourly people, or just, I guess, the reduction in wages. Say they were working a lot of overtime, 50 hours a week last year during one of the measurement periods, and now they're earning the same per hour, but they don't have as many hours. Is that still a reduction in wage?
No, that's you're keeping them at the same either salary or hourly rate, so that's not a reduction in wage. What that could affect is your FTE count if they end up falling below that 30 hours. But if they stay above the 30, that won't affect the FTE count either.
Okay, so the main theme is there's always, how many different limits are there? Did we say 4? 4 different ones. They all interact, and everyone you're talking about might just trigger something else. So please go to our website. That big Excel sheet that we have is really powerful. Reach out to any of us to kind of go over how that works. If people would want to hop on for any last questions, I think we're just over time, so I don't want to keep people much longer than they have to on a beautiful Minnesota spring day. So I was going to wrap up. Any outstanding questions, if we didn't get to yours very well, or if it's just open and we didn't address it at all, please reach out. We're here. We're happy to talk. This is what we've been doing. I don't think any of us have done less tax work in April than April 2020. We are now loan, unemployment experts and payroll experts. So it's been very interesting, but please reach out. This webinar will be up on the website within 24 hours, I say, with our nice marketing person on, and these slides will be available, and we'll just keep watching our website because we're going to be updating stuff, and we'll be doing more webinars and more specific ones for certain groups. And I think that about wraps it up.
Yes, thank you, Nick. Yes, I appreciate my team, and I appreciate every one of you taking the time to be with us today. So be well, stay healthy, and reach out as you have questions. We're here to help.
Thanks, everyone.